how job data became an inflation measure, a really interesting set of correlations we're going to dive into here in just a second, showing that, whether it's the JOLTS job opening number, the non-farm payrolls number, any economic data really at this point is being interpreted through the lens of high inflation or low inflation. Before we get to that, I do want to kind of show you the theory that I'm, trying to test here with these correlations by using one that is relatively tried and true, historically founded, which is stock correlation tends to increase as stocks fall. As volatility enters the stock market, as fear enters the stock market, stock correlations between Apple, Microsoft, Amazon, ExxonMobil, all these different stocks, JP Morgan, different sectors, they tend to become more correlated. And here you have in front of you is the last year's worth of data for the S&P 500 correlation index, and that's provided by the CBOE. And so what this theory dictates is that correlations, and this correlation index tends to increase, become positively correlated between stocks as stocks move lower and fear increases. Now, from a practical level, we'll get back into the data in just a second. From a practical level, what I'm trying to say is, if the market is crashing or the market is witnessing fear, it's moving lower, then stocks kind of become relatively synonymous, right? Like if the market's down 30%, what's really the difference between Apple, Microsoft, Amazon, or what have you? Now, on the flip side, if the stock market is humming along, increasing by its normal historical average of around 6 to 7% annually, then you can have some big divergences. Then you're really looking at like, okay, what's particularly going on in Apple? What's particularly going on in Amazon? But for lack of a better explanation, when it rains, it pours. And that's for every stock, every sector, usually. Now, diving back into the data, keep your eyes on the trend here of correlation over the course of the last year. Looks like correlation was at its high in October, November of last year, and it's been a bumpy road of correlation, but it's been largely a trend lower over the course of the last year. Now, looking at the S&P 500, I'll be damned if this isn't a almost direct inverse, right? You see the low in the stock market hitting in about October, November, and then bouncing back in, a bumpy road, but trending higher over the course of the last year. When stocks rise, correlations tend to be less meaningful. Then you're really dissecting, like I say, the difference between Apple and Microsoft to the upside. A lot of times can be, 10, 20% in a given year. But if the stock market's down 30%, let's say, it's likely that Apple and Microsoft and all these different stocks are going to be, very marginally different. Apple might be down 30%, Microsoft might be down 32%, Amazon might be down 28%. And just to hammer home this correlation between correlation and stock prices, I'll just flash back and forth again. Same time frame, S&P 500 in front of you, and now going back to that correlation, you can see a pretty direct inverse here. Good time for stocks, lower correlation among stocks. Bad time for stocks, they tend to trade very similarly. Now, bringing this back to inflation, we're seeing a very similar story play out between all the economic data in the US. And what I mean by this is, when inflation rises, when it gets above the 2% target, as you see it's been for the last 2 years pretty much here, economic data tends to all become correlated to inflation. And you can kind of feel this if you've been trading for a number of years. That, in a lot of environments, non-farm payrolls and the inflation, CPI inflation, PCE inflation, GDP, all these different numbers can tell different stories when inflation isn't high, and that's not kind of taken over the news cycle. But when inflation is high, these economic data releases all become very correlated, and they kind of become seen through the same lens. And as an example of this, you look at wage growth here, that it might not surprise you at all to see the fact that wage growth is highly correlated to inflation. Makes sense. If people are getting paid more, they're spending more on goods and services. The prices of goods and services are increasing. But what's more interesting to me is that jobs data in general has become less of a signifier of the overall health of the U.S. economy. And, in a low inflation environment, good jobs data, good economy, good for stocks and everything else, and now has been really seen through that lens of inflation, whereby good jobs data, higher wage growth is actually bad for stocks because it's being translated as higher inflation and potentially higher interest rates. And I guess that's where we conclude this big correlation segment is, not only is jobs data and GDP that we saw reported from the US recently, all being kind of correlated to the inflation story, given that we're still in a high inflation environment, but that's all also being correlated to interest rates. I mean, it's really interesting to see, especially that red line you have in front of you, the US 2-year interest rate looks almost exactly like the chart of inflation and the chart of wage growth over the course of the last couple of years here, which is to say a stair step higher and then an evening out, a plateau, if you will, starting in the summer, fall of 2022. And just to show that correlation again, I'll flash back and forth to wage growth, where you see that story. It peaks in 2021 and then plateaus and has been moving a little bit lower. And then here, the core PCE data, peaking in 2021 and then plateauing and edging lower, but not necessarily, falling back to where it was. And obviously, this all has an effect on that stock market where we started here. But interesting to see these numbers all come together and to look at the correlations between these different economic measures that, like I say, in a 2% inflation environment, you can look at that non-farm payrolls number and interpret it as, higher number, better for the economy. Right now, for better or worse, almost all economic data in the U.S. is being interpreted as an inflationary number, and markets right now are also very highly correlated to inflation, in that higher inflation or higher non-farm number, higher interest rates, and a lower stock market, and also the effect on U.S. dollars, a positive correlation to inflation as well. So a nice deep dive here today, especially going into another upcoming non-farm payrolls number, but then soon to follow that, another CPI number, another PCE number as well. Obviously, the measures continue on a monthly basis. For the time being, you're seeing that correlation, though, go to 1 with inflation.